Right now, there is $2.5 trillion sitting in the stock market actively betting on absolute boredom.
Which is just, it's a staggering number.
It really is.
Oh.
Think about that for a second. We're talking about $2.5 trillion.
Yeah.
And that's 5 times the amount from just 4 years ago.
Yeah, exactly. Up from 500 billion.
Right. And all of it is parked in these financial products that are specifically designed to profit only if the market does, well, essentially nothing.
Nothing at all.
So on the surface, if you just pull up the major index numbers, the market looks like this frozen lake, just perfectly flat. But beneath that glassy surface, there is an absolute hurricane brewing. And the ice is really starting to crack.
It is a completely deceptive environment right now. The tranquility you're seeing on your screen doesn't match the actual mechanics of where capital is moving.
Right.
And more importantly, it hides the massive amount of leverage that's just building up in the dark. It's just waiting for a catalyst.
Okay, let's unpack this because we have a massive stack of sources today. All of them are dated around May 26, 2026.
A lot to get that through.
Yeah, tons. We're synthesizing macro strategist notes, summaries from top crypto influencers, on-chain data, and the latest news headlines.
All the pieces of the puzzle.
Exactly. And since you listening right now, are sitting right here as the third person at the table for this deep dive, our mission today is to figure out why things feel so dangerously stuck on the surface while absolute chaos seems to be tearing through the currents underneath.
And to really understand the digital asset space right now, we actually have to start by looking at traditional finance.
You can't separate them anymore.
No, you can't. Their fates are just deeply intertwined. You really cannot understand the stagnation in crypto without, understanding the massive pressure cooker building up in the broader traditional markets.
Which brings us back to that $2.5 trillion number.
Mm-hmm.
I was reading the latest notes from Jim Carson. He's a prominent macro strategist at Kai Wealth Advisors.
Right, the guy who called the last 2 summers.
Exactly. He has this crazy track record of calling this exact sleepy sideways market pattern for the last 2 summers in a row. But now he's issuing a really stark warning.
He's not saying it's going to be sleepy this time.
No, quite the opposite. He says the stock market is quietly building toward one of its strangest and potentially most volatile summers in years.
And the data he highlights to back that up is just staggering.
It's wild.
The S&P 500 is sitting completely flat. But it's not flat because investors are calm or, because the economy has reached some perfect equilibrium.
No, it's an artificial calm.
Exactly. It's artificially anchored in place by those volatility suppression products we mentioned. These are complex derivative instruments. They usually use option strategies that basically systematically sell volatility.
So as long as the market stays in a tight, boring range, they just print money.
They do. But that creates a huge mechanical problem.
Right. And to help visualize this, the way I think of it, it's like holding a beach ball underwater.
Oh, that's a good way to put it.
Yeah, like the surface of the pool looks totally undisturbed.
Yeah.
Perfectly calm. But the pressure building up around your hands is immense. And when it slips, it's going to shoot straight up or violently sideways.
That is an excellent analogy. And what's fascinating here is where that suppressed energy is currently bleeding out.
Because it has to go somewhere.
Exactly. Because the main S&P index is being held in this vice grip by that $2.5 trillion anchor, the market's natural momentum has to find an outlet.
Right.
Carson notes this is causing chaotic, just violent sector rotation entirely underneath the surface. You've got semiconductors and artificial intelligence companies swinging 5, 6, or 7% on a random Tuesday afternoon.
While the main index barely twitches.
Exactly. The headline index does nothing.
So if you're just looking at your standard 401k right now, you might be thinking, oh, everything is completely fine. The S&P looks stable.
But it's a mirage.
Right. Carson's data tells us that your portfolio stability is currently just an optical illusion. And I want to push back on the doom and gloom aspect of this a little bit.
Sure.
When you mention, dangerous pressure and the stored kinetic energy, my mind immediately jumps to a systemic 2008 style banking failure, like total meltdown. Is that what Carson is actually warning about here?
No, not necessarily a systemic banking crash. And that is a really crucial distinction to make.
Okay, so what is the risk then?
The mechanics are different here. Carson is warning that the AI and semiconductor trade has just gotten dangerously crowded. I mean, everyone is on the exact same side of the boat.
Oh, so it's a positioning issue.
Exactly. Too much capital has chased the exact same tech names. That pushes their underlying options prices sky high and creates this very shaky foundation. You don't need Lehman Brothers to collapse to cause real pain here.
It just takes a small spark.
Yeah, just a slight slowdown in that AI momentum could be enough to force over-leveraged funds into a corner.
Wait, if the market just slows down, why are they forced into a corner? Like, who is forcing them to do anything? They could just hold, right?
Well, it comes down to leverage and margin calls.
Borrowed money.
Right. When funds borrow money to maximize their returns on these AI stocks, they have to maintain a certain level of collateral with their broker.
Okay.
So if the stock prices dip even slightly, their brokers demand more cash. And if they don't have the cash sitting around, they are forced to sell their positions immediately to cover the debt.
Which cascades.
Exactly. When everyone is forced to sell the exact same AI stocks at the exact same time, you get a fast, incredibly ugly unwind.
Wow. Okay, so the exit door is tiny and the building is absolutely packed.
That's a perfect way to describe it.
And if forced liquidation in these AI stocks threatens to drag down risk-on assets across the board, you would naturally expect crypto investors to be, actively bracing for impact.
You would think so.
But instead of panicking or preparing, Bitcoin is just completely asleep at the wheel. I mean, it's just sleepwalking.
Sleepwalking is the perfect term for it right now. Bitcoin is stuck in what analysts call a crab market.
Because it just walks sideways.
Right, just walking sideways in this really tight, uninspiring range between $76,000 and $78,000.
And the on-chain flows show that demand is completely dead. We've seen $2.3 billion in ETF outflows over just the last 2 weeks.
That's a massive drain.
It is. It's a massive draining of the institutional demand that was previously holding the whole market up. And on top of that, major strategic deployments from the large buyers are just sitting on pause.
Right, the treasury strategies.
Yeah, they are officially holding off on any more buys until STRC hits $100. Capital is simply frozen.
But, a frozen market doesn't mean a broken market. If we connect this to the bigger picture, we really need to look at Benjamin Cowen's analysis from May 26th.
Oh, this was fascinating.
Yeah, because for the last year, there's been this prevailing, very loud narrative that the arrival of Wall Street ETFs fundamentally broke Bitcoin's historical 4-year cycle.
Right, the supercycle theory.
Exactly. The theory was that institutional money would just smooth out the volatility and prevent the deep bear markets we've seen in the past. But Cowen completely rejects that premise.
He does. And he makes a highly compelling, purely data-driven case that the 4-year cycle gravity is still completely in control.
Completely in control.
She points out that Bitcoin actually topped out almost to the exact day that it historically always does in its cycle. I mean, it matched the timeline of prior cycles within a single week.
Which is wild.
Yeah.
And he also addresses this major psychological trap that a lot of investors fell into this time.
The lack of retail mania, right?
Yes. Many people assumed that because the market didn't experience that wild, euphoric, retail-driven frenzy at the top this time around, it couldn't possibly be a true cycle peak.
It just felt too quiet.
Exactly.
But Cowen notes that markets can, and often do, top quietly. He brings up the traditional stock market in the late 1960s, which did the exact same thing.
Oh.
A quiet, exhausted top absolutely does not invalidate the possibility of a grinding bear market following right behind it.
Exactly. And when he mapped out the current price action, he found it is tracking the 2018 and 2022 bear market cycles almost move for move.
Move for move.
We saw a definitive low in February, a higher low in April, and a peak in May. Rallies lasting 16 weeks might feel like a new bull market, but he emphasizes that they are completely normal within these broader bear market structures.
Right, they're trap rallies.
Yeah, in past cycles, these counter-trend rallies stretched to 25 weeks before the real devastating new lows finally hit.
So the key takeaway from Cowen is that betting against the historical 4-year cycle is just incredibly dangerous.
Very dangerous.
Every time Bitcoin has rallied up to touch its 200-day moving average during a structural bear market, it has eventually rolled over and dropped further. The data points to another significant leg down, with a possible final cycle low bottoming out around October 2026.
And while all of this technical exhaustion is playing out on the charts, the macroeconomic environment isn't offering any relief at all.
No, it's making it worse.
We have an incredibly thick geopolitical fog adding to the stagnation.
Yes, the geopolitics right now are messy. Specifically, the market is completely paralyzed by the conflicting reports coming out of the U.S.-Iran negotiations.
Oh, this weekend was crazy for that.
Right. And just to be clear, we are strictly neutral here, just reporting the data from the sources. Over the weekend, Donald Trump publicly claimed that a peace deal is nearly finalized and that a 60-day ceasefire extension is close to being signed.
Right.
But almost immediately after, Iranian officials countered that statement. They explicitly stated that they were told to ignore those public comments, claiming they were purely for domestic consumption in the United States.
So you have two completely opposing narratives.
Exactly. And as a result, the market simply doesn't know how to price the reality on the ground. There's a profound lack of clarity.
And you have to understand how large capital allocators think. They despise uncertainty far more than they despise bad news.
Because you can price in bad news.
Exactly. Bad news can be modeled, it can be priced into a spread, but pure uncertainty. That forces major capital to just sit on the sidelines and wait for the dust to settle.
And we are seeing that exact wait-and-see approach from some of the oldest players in the space. The on-chain data flagged a Satoshi-era Bitcoin whale.
Wow, an original.
Yeah, someone who has held their coins since the absolute earliest days of the network's existence. They just moved 2,650 Bitcoin.
Which is what, over $200 million?
Yeah, roughly $203 million. They moved those funds to FalconX and Cumberland.
And for some context for you listening, FalconX and Cumberland are major over-the-counter or OTC trading desks.
Right.
When a whale wants to sell or restructure hundreds of millions of dollars in crypto, they don't just dump it on a public exchange like Coinbase or Binance.
That would be a disaster.
It would. A market order that size would instantly crash the spot price. OTC desks allow them to negotiate private trades directly with institutional buyers.
Right. It's a way to move massive volume quietly. But it's also really important to note from the data that this whale still retained nearly $500 million worth of Bitcoin in their original wallets.
So they didn't sell everything.
No, it looks more like defensive portfolio reshuffling than a total panicked capitulation.
Which perfectly encapsulates Bitcoin right now, right?
Yeah.
Defensive, quiet, and stuff.
Yeah.
But if we shift our focus to the second largest asset in the space, the picture gets much darker. Ethereum is currently experiencing what can only be described as a full-blown existential crisis.
Oh, absolutely. If you look at Virtual Bacon's breakdown of the ecosystem, the fear, uncertainty, and doubt surrounding Ethereum is reaching a fever pitch.
It's bad.
From a pure price perspective, ETH is currently sitting near a 9-year low against Bitcoin. It has been slowly bleeding out against BTC for years, repeatedly posting lower highs with every single cycle.
But the panic right now isn't just about the chart. It's about the architects actually building the network.
Right. And that is the most alarming data point in the recent sources. 8 senior contributors to the Ethereum Foundation departed in a matter of months.
That's a huge brain drain.
And it includes all 3 of their primary protocol leads. When the top engineers and visionaries start leaving the building in droves, the broader community naturally just panics.
And why are they leaving? It seems to be a massive identity crisis. I mean, Ethereum was originally built on this decentralized cyberpunk vision of a world computer.
The unstoppable code.
Right, but that ethos is currently colliding violently with institutional reality. Retail users want fast, cheap networks to trade meme coins, which is why they are flocking to Solana.
Yes, Solana's eating that market.
But meanwhile, Wall Street institutions want a highly secure, regulated settlement layer. The Ethereum Foundation seems torn between these two completely opposing directions.
It got so severe that Vitalik Buterin had to publicly address the community. And he made a very difficult admission. He said the Ethereum Foundation simply can no longer act as the central driver for what has evolved into a $200 billion global ecosystem.
They have to let the broader market take the reins.
Right. But looking at who is actually taking those reins on the demand side is terrifyingly thin.
Very thin.
According to the data, a corporate entity named Bitmine appears to be the only meaningful buyer left supporting the price of Ethereum right now. They recently purchased 60,000 ETH, which translates to about $126 million.
But here is the critical mechanism of risk that we need to highlight with that. Bitmain isn't just casually buying the dip. They have a stated public target of acquiring 5% of the total global Ethereum supply.
5%.
And they are getting dangerously close to hitting that exact number.
Which creates a massive centralization risk. I mean, if Bitmine is essentially becoming the single load-bearing pillar for Ethereum's price, what happens when they hit that 5% target and stop buying?
Exactly.
If one single entity is holding the floor, that isn't decentralized demand. It's a single point of failure waiting to happen.
It is. When that sole pillar of massive demand vanishes, the floor could drop out entirely. You even have longtime hardcore Ethereum loyalists, like the hosts of the Bankless community, who have publicly stated they are selling down their ETH positions.
Wow.
When the staunchest, most vocal defenders of a protocol throw in the towel, it tells you exactly how deeply the sentiment has rotted.
Okay, but here's where it gets really interesting to me. Historically speaking, isn't peak apocalyptic fear usually the absolute best time to look closer at an asset?
It usually is.
When everyone else is running for the hills, that's usually where generational value hides. Does Ethereum actually still have a structural edge, or is it genuinely just too slow and too rigid to survive the next 5 years?
That is the multi-billion-dollar question. And this is the massive contrarian but that Virtual Bacon points out in his analysis. Despite all of this retail negative sentiment, despite the foundation departures, every major real-world asset platform is still building on Ethereum.
And just to clarify for anyone unfamiliar, real-world asset, or RWA platforms, are protocols designed to take traditional financial assets, like real estate, U.S. treasuries, or corporate debt, and tokenize them on the blockchain so they can be traded instantly.
Precisely. And virtually every institutional bank exploring tokenization and almost every major decentralized finance fork still relies on Ethereum's core technology.
So the tech is still the standard.
It is. It may not be the flashy, fast app layer that retail traders use for microtransactions anymore, but it has solidified its position as the ultimate secure settlement layer for institutions.
Right.
Because of those deep institutional roots, Virtual Bacon actually targets a drop to $1,600 as the ultimate value play of the next cycle once the broader market finally bottoms out.
Okay, so if the heavyweights, Bitcoin and Ethereum, are struggling under the weight of market stagnation, and traditional macro markets are slat but internally chaotic, we have to ask, where is the capital actually moving right now?
Because money never just sleeps.
Exactly. It always looks for an edge in the undercurrent.
Capital is seeking out what analysts call pockets of strength. And the sources point to a few very specific micro-rotations happening right now.
The narrative around HYPE is dominating. The CEO of Bitwise recently noted that their hyperliquid ETF volume is currently beating almost every other crypto ETF on the market.
It's massive volume.
Yeah. We're also seeing targeted strength in what traders call beta plays.
Right. And a beta play essentially acts as a leveraged, higher-risk bet on the success of a larger ecosystem. If an investor believes a major network is going to succeed but wants higher upside, they might buy a smaller token built on that network.
It makes sense.
Our sources highlight LIT as a prime example of a strong beta play right now.
We're also seeing AI-related crypto names like Near popping off, which recently got a massive sentiment boost simply because Arthur Hayes mentioned it.
Oh, the Hayes effect.
Yeah. For context, Arthur Hayes is the former CEO of BitMEX and one of the most widely followed essayists in the crypto space. When he talks about a token's mechanics, hundreds of millions of dollars in retail liquidity tend to follow his thesis.
It's incredible how much influence he has. But, perhaps the most fascinating detail in our entire stack of sources isn't even a crypto asset.
Oh man, I have to admit, out of all the next-gen infrastructure plays we read about today, the one that caught me completely off guard was a legacy tech name, BlackBerry.
The phone company.
Right. How did a phone company from the 2000s pivot so hard that they are now a quiet hero in this highly advanced market?
It's a brilliant survival story. They completely abandoned hardware and shifted entirely to enterprise software and quantum protection.
Quantum protection.
Yeah. In a world where digital asset security is becoming an arms race against quantum computing threats, BlackBerry quietly positioned themselves as a vital security layer. It proves that the real alpha right now requires looking outside the obvious crowded trades.
And within the crypto space itself, the focus has shifted away from pure token speculation and entirely toward heavy infrastructure building.
Right. The old saying, bear markets are for builders.
Exactly. And the current developments absolutely prove that. Look at what Hyperliquid is doing. They just launched native prediction markets that are governed entirely by validators.
Which is huge. To understand why that is a massive leap forward, we have to look at how prediction markets usually function. Normally, if you place a bet on a blockchain about a real-world event like who will win an election, The blockchain can't look out the window to see what happened.
Right, the blockchain is blind to the real world.
Exactly. It relies on an oracle, which is an external data feed, to report the outcome back to the chain.
But oracles create a bottleneck, right? They can suffer from latency issues. Or worse, they can be manipulated by bad actors to report the wrong outcome and steal the funds.
Exactly. The oracle problem has plagued decentralized finance for years. By governing the markets directly through their native network validators, hyperliquid is completely removing the need for external oracle systems.
That's incredibly smart.
It is. It makes the resolution of these markets faster, entirely native to the chain, and arguably far more secure against manipulation.
That is a massive upgrade for capital efficiency. And they aren't the only ones building the picks and shovels for the next cycle. OKX just launched something called Exchange OS on their X-Layer network.
Oh, yeah.
It essentially allows any developer to create custom spot, perpetual, and prediction markets using OKX's shared on-chain liquidity infrastructure.
We are even seeing infrastructure innovation happening at the sovereign level. Tether, the company behind the $100 billion USDT stablecoin, announced plans to launch GELT.
Gelting, right?
Yeah. This is a digital stablecoin pegged to the Georgian lari, and they are doing it with actual government support to build out programmable payments and settlement infrastructure in the region.
And with all of this multi-chain movement, capital flowing across new DeFi protocols, custom trading venues, and sovereign stablecoin security naturally becomes the absolute bottleneck for users.
It has to be top priority.
That's why the sources consistently highlight platforms like OpenWallet. In a fragmented period where your assets might be spread across 10 different chains and the risk of smart contract exploits is incredibly high, tools that provide advanced security, seamless cross-chain integration, and real-time portfolio tracking aren't just convenient.
They are essential for survival.
Exactly.
This raises an important question for anyone trying to navigate this environment. What stands out to you in these micro-rotations? Because the overarching theme across every single source we reviewed is that the era of blind buying is completely dead.
It's gone.
Extreme patience, deep understanding of mechanics, and intense selectivity are the only ways to survive a market that looks frozen on the surface, but is rotating violently underneath.
So what does this all mean when we put the puzzle pieces together? Let's zoom out. We are currently living in a traditional financial market that is artificially propped up by $2.5 trillion of volatility suppression.
It looks calm, but it is a dangerously pressurized shock absorber.
Meanwhile, Bitcoin is tethered to the gravity of its historical 4-year cycle, slowly bleeding toward a potential bottom.
Right.
Ethereum is navigating an incredibly painful, but perhaps totally necessary, identity transition from its cyberpunk roots to becoming true institutional infrastructure. And the real opportunity is hiding in highly selective, complex infrastructure projects.
It is a market environment designed to punish impatience and reward deep structural research.
Exactly. But I want to leave you with a final thought, something to really chew on based on the data we just went through. Let's logistically play out the collision of the two biggest predictions we discussed today. If Benjamin Cowen's cycle data is right, Bitcoin is scheduled to finally bottom out around October 2026.
Right.
But what happens if that exact moment collides with Jim Carson's fear of the over-leveraged AI trade violently unwinding in the stock market?
Oh, wow.
Think about the logistics of that synchronization. If that massive $2.5 trillion dam of artificial calm breaks and traditional funds face massive margin calls, forcing them to liquidate everything, what does that look like mechanically?
That's a scary thought.
Will the resulting panic cause the ultimate catastrophic crypto wipeout, freezing OTC desks and breaking stablecoin pegs as everyone rushes for US dollars?
Or does the opposite happen?
Exactly. Because Bitcoin will already be at its absolute cyclical point of maximum exhaustion, will it instead act as a vacuum? Will it force all of that stranded, panicked, TradFi liquidity directly into Bitcoin as the ultimate escape hatch?
That would be historic.
When that $2.5 trillion beach ball finally slips out from under our hands, is it going to drown the entire financial system? Or is it going to act as the exact catalyst that shoots crypto straight into its next massive bull run?
The mechanics of how those two forces interact will define the next decade of finance.
It really is the ultimate test of the system. Thank you so much for joining us on this deep dive. Keep digging into the data, keep questioning the surface narrative, and above all, stay curious. We'll catch you next time.